Good morning, everyone. Welcome to our webinar on ESRS 2.0. We're going to be talking today about what EFRAGs new data points mean for your reporting. As we welcome everyone in, we'll just wait a couple of seconds, but I'll introduce myself. I'm Freddie. I'm a sustainability researcher here at CoolSet, and I'm joining my colleague Jasper, also a sustainability researcher. And we've been working on ESRS, among other things, for the past couple of years or so. So we've seen them change through many iterations, and we're here to talk to you about the latest version. So I think on the 28th, there was the release of the new ESRS data points. So we'll talk you through the changes in those and what that means for you and your company. It will host a webinar. And as always, if you have any questions, please put them in the Q&A section. That's the bottom right of your screen, and we'll get to those at the end. So we'll answer those questions at the end. So put anything you might want to know there, and then there's a chat function. Maybe let us know if anything you can't hear as well, or maybe we have some technical issues. But other than that, we'll probably get started while everyone's still joining. But happy to have you all here today, especially when people are starting to slow down for Christmas. So it's great that so many of you are showing up. So thanks for that. Nice to see we've got some people from Portugal even today. We're based in Amsterdam in the Netherlands, so diverse crowd around us. But I think as people join, we'll start to get ready. So we'll start with a small agenda for today. We'll start with the EFRAG update. So what's the news, some politics behind what's been happening. Then we'll look at ESRS 2.0 more broadly and what that means, and then zoom out a little and have a bird's eye view of what was existing and now what's changing with the new ESRS. And then Jasper will take over to do... Oh, we've got an early poll vote. Well, should we do that one now?
Yeah, might as well.
Technical issue, but we'll go with it. A question for you all anyway. So what type of guidance would you find most useful after we talk you through the vote and the new data points? But maybe this will be useful to know anyway. Would you like to see a clear in and out scope decision tree, practical timelines and checklists, supplier communication templates, ESRS data requirements overview, or tooling and automation support? Basically, we want to know how we can best support you going forward, what kind of data and guidance you find most useful. So seeing here, about 40% of you finding a ESRS data requirements overview the most useful thing, and about a quarter with timelines and checklists. So that's really helpful for us to know what kind of content to make and put out for you all. So keep an eye out on LinkedIn and newsletters, and we'll share those guidance documents with you. Great. Back to the agenda. So then we'll go on to some technical updates of ESRS and any further changes, and finally prepare you for the next steps, and we'll end, as always, with a Q&A. Great. So the latest from EFRAG. Firstly, I think it's always good to start with a reminder of who EFRAG is. EFRAG are not an EU institution. They operate independently, but also under the Commission. So they're essentially the technical advisor for sustainability and financial reporting. They began in 2001, born from the financial reporting reform, and the sustainability branch only expanded in around 2022. So pretty new to the sustainability reporting scene, but a crucial part of it. And they're a politically balanced coalition, so they have a mix of business leaders, NGOs, investors, and audits from all around the EU, and their advice is important in shaping the ESRS, but Brussels can't override them at any time. So yeah, just a reminder that they're an advisory body, but they're not making the decisions ultimately. And the EFRAG vote. So as I said, it's a mixed board, and it's made up of sustainability reporting board members. And 22 of those members were voting on the new ESRS. And the result was that all 12 ESRS were approved. You can see the image on the right here, a majority of green, which means approval. Yellow, I think, is voted approval with some reservations, and red is dissent. But for an ESRS to be approved, a qualified majority was required, and this was reached on all ESRS. 5 of them qualified by majority and 7 by consensus. And several members were voting with reservations, which meant they voted for, but they did have reservations which were made explicit. For example, one member dissented over E2 over a microplastics requirement. So that maybe was to do with the regulation on specificities of microplastics. But yeah, you can delve more into this on their website and see exactly who was voting on what and why. It's a really interesting analysis to see. But overall, there was broad approval under quite intense political time pressure. And going on to what exactly was published. So we've seen 12 amended ESRS standards. For those of you who joined in October, I believe we did an overview of these standards, but since then they've been changed a little more. So from ESRS 1 and 2 to E1 to 5, S1 to 4, and also G1. We've also seen updated mandatory disclosure requirements. So these have been simplified, been made shorter, and been restructured. So as we again explained last time, lots of information has been moved into ESRS E1 and 2, making requirements more general, whereas the specificities are kept in E1 to E5 and the more specific ones. We've also seen updated application requirements. That's clearer guidance across all standards on how to apply them. And we've seen a revised architecture. So GDR structure means general disclosure requirement structure, and that's replaced the minimum disclosure requirement structure. So yeah, again, just a restructuring of ESRS. We've seen a streamlined DMA, which we'll go into a bit later, and reduced granularity. And if you want more information on this and the reasoning behind it, I'd highly recommend you look at the EFRAG cover letter to the Commissioner, which explains the vote and the context and rationale for these changes. It's around 17 pages or so. So nice to kind of understand a bit more of the background for this. And what's still coming? So we're not done yet. So the majority has been published, but what's still to come is the basis for conclusions, cost-benefit analysis, and an explanatory note. And this is something EFRAG has agreed with DG FISMA, which is the European Policy Board for Financial Reporting. And that's supposed or promised to become by the end of December, so in a couple of weeks. And then this has been published by EFRAG, but now we still have to wait for the European Commission to incorporate this into the amended drafts. So this could be as late as summer 2026. So still quite a while to go until this is made legislation by the European Commission, but this is a next step. And something else that's new, which was published just a week ago, is the new ESRS Knowledge Hub. We found this really useful to just be a bit more interactive. It's a space where they have free and interactive breakdowns of all the standards, both old and new. Makes it a bit easier to understand where things have changed, and you can click on sections for definitions and it links across standards. So it's a really nice platform to learn a bit more about ESRS and make it a bit more practical. And finally, we can see Patrick de Kamberg's letter to the European Commission here. Just kind of gives a nice overview of the changes that EFRAG have made and the rationale behind it. But he says, overall, I believe that the amended ESRS compared to the initial ESRS strike a reasonable balance between meeting the core policy objectives of the European Green Deal and alleviating unnecessary administrative burdens on undertakings. So that balance again between keeping in line with the Green Deal policy, but also ESRS is restructured more succinctly and in kind of the manner that financial reporting is done. So yeah, towing those two lines, and they seem to be content with the result they've delivered. Great. Now zooming a bit more out to ESRS 2.0, so not just EFRAG, but ESRS in itself. Just a reminder here that CSRD and ESRS are not the same thing. A lot of the focus of Omnibus proposal has been on CSRD, which is the scope, but it's important to remember this is different from ESRS, which is the content. So the scope is determined ultimately by European institutions, whilst ESRS is the responsibility of EFRAG. Again, it is ultimately determined by European institutions, but it's not kind of created by them. If we look on the next slide, we'll see the scope. So this is CSRD, the scope. We can see this has had a reduction of over 90% of who's in scope. So this is what the European institutions have been voting on. We see previously the original CSRD, around 45,000 companies would have been in scope. And with the changing votes on scope, this has been recently proposed at 1,000 companies with 1,000 employees and I believe 450 million euros of turnover. So that results in only around just under 5,000 companies being in scope of CSRD. So that's the broader picture. But if we look at ESRS scope, it's less about who has to report, but what they have to report on. And again, we can see a significant reduction in data points. If you look on the right, originally, there were over 1,000 data points that companies have to report on, and now this has been reduced to around 61% of that initial 1,000, so 320 data points. And if we include voluntary data points in that, it's around a 71% reduction. And if you go further and actually whilst you're doing ESRS and you do the double materiality assessment, not all these data points will be relevant to you. So an even larger proportion of reduction in data points. So we can see both at the scale of the scope, but also within ESRS, there's been a huge reduction in who has to report and what they have to report on. And how have EFRAG gone about this simplification? They have used 6 simplification levers. This has been outlined in the letter, but also in the documentation. And these begin with a simplified double materiality. So for those of you that have done double materiality assessments before, it's quite complex. And we've seen now clearer rules and fewer mandatory checks. There's been increased readability and conciseness, shorter standards and less duplication across ESRS, and restructured general versus topical disclosures. So pattern M, which is policies, actions, targets, and metrics have been pulled into ESRS 2, meaning, they're more broad and general rather than specific. We've also seen improved clarity and accessibility, clearer definitions and fewer subtopics, and the complete removal of subtopics. And this, I think, has been further improved by the ESRS Knowledge Hub, which helps with these definitions and understanding. Revised burden reduction reliefs, so estimates are now allowed, which previously weren't, value chain, inclusion, exclusion, and reduced undue cost and effort. And finally, there's been greater interoperability with ISSB, IFRS, S1 and 2, and the GHG protocol. So ESRS is kind of, being more coherent with other frameworks that companies might have to report on. And finally, a quick look at the timeline. Some of you might have seen this one before, but just to remind you on the process. So we first saw ESRS adoption in July 2023, and this formed the baseline for Wave 1 reporting. Then in February, as many of you remember, I'm sure, the Omnibus proposal came about, and this is when adjustments to the CSRD and ESRS framework were proposed. And then over the summer into the autumn, EFRAG have been preparing the simplification package. So they published their first drafts of the exposure drafts, the NIG log of amendments, and the BFC for public consultation. And that had, I believe, a 60-day consultation period. And then at the end of November, the new ESRS Delegated Act was published. So the next step in this is, as I said, the European Commission to include it in the amended drafts, and that's expected to happen before summer 2026. And we've already done this poll, so we can skip it. Great. And now zooming out again to having a bird's eye view. So I think for many, it's very useful not just to see what's coming up, but also where we've come from and see the changes. So we'll just give you a brief overview of these changes. What has been reduced? So as I said previously, the 6 simplification levers were focusing on kind of simplification at a granularity scale. So we've reduced, EFRAG have reduced site level, geographic level, and subtopic splits completely. So reduced granularity, which helps with simplification of reporting. Duplication has been reduced. Previously, there was a lot of overlapping data points across standards, so something in E1 might also be repeated elsewhere. Now, a lot of this has been removed or moved into ESRS E2, I believe, rather than throughout the standards. So reduced duplicated work. We've got fewer context metrics, so fewer detailed workforce and narrative breakdowns, and a topical PAT and M cut. So as I just said, most requirements have been centralized in ESRS 2. And the hard data burden has been reduced slightly. So rather than having to have data on lots of things, there's more room for estimates, partial scopes, and proxies where you don't quite have the data just yet. And if we look at the other side, what hasn't been reduced? So what's staying the same? The climate expectations remain. So this is kind of the core of ESRS, having these targets, transition plans, and scope 1 to 3 boundaries remain the same. And this again allows for that interoperability between the GHG protocol and ESRS. Having adequate wages and human rights is an unchanged core obligation, so that's a non-negotiable for all companies, and including anticipated financial effects is still required, but it's only been phased. In terms of governance and control, there's been no relief. This is also central to ESRS 2. And entity-specific disclosures are now more important rather than less. So this is one of the changes we've seen. A lot of reductions in areas, but also some additions and emphasis of importance. And finally, we're seeing higher materiality scrutiny, so given flexibility and overrides. Now I'm going to pass over to Jasper, who's going to talk about the DMA, I believe, and carry on from here.
Thanks, Freddie. Yeah, so I think what we've heard now is the very interesting part of the changes. And I'm going to take you through the drier part of the changes. So the more technical amendments and what we're seeing. So bear with me as we go through it and as we kind of explore, the details of what's to come. Of course, we also didn't want to kind of bore you to death with very detailed specific changes. And also we only have 45 minutes for this whole session, including a Q&A. So we're going to focus on some key changes. And then, of course, if you have any more questions, feel free to reach out to us afterwards. So to begin with a overview of the simplified double materiality assessment. First of all, I think it's really important to mention here that this is being simplified in I think a very practical manner, but the core principle remains. So of course, for those of you that have worked with the DMA before, you'll know that it revolves around impacts and financial risks and opportunities, which are known as IROs. And IROs essentially form the basis of the DMA. So the DMA still revolves around identifying IROs, matching those to your business model, and then matching those to the ESRS topical standards. That hasn't changed, but what has changed is that there has been quite a simplification drive. So as Freddie also mentioned, there has been an update of the subtopics, and a removal of all subtopics. So just to give a bit of a picture of numbers, there were around 37 subtopics and more than 100 subtopics. And often in my work with customers, I found these subtopics to be overly granular and kind of go at the expense of the overall process in which you identify work for the company. What we're also seeing is greater flexibility. So there's an increased usage allowed of proxies, indirect data, and judgment. So before that, it was a bit stricter, but we're seeing that there's more flexibility here now. So secondary data is more accepted, which makes it easier for companies to identify materiality. So for example, you can refer to secondary articles, you can refer to peer articles, you can refer to public databases that will help you identify whether something is material. And obvious IROs are no longer subject to extensive DMAs. So for example, if you're a newspaper company, then everything related to paper will clearly be material. So for example, ESRS E4 biodiversity might become material because of deforestation, but also ESRS E1 climate change mitigation will be material because of your intense use of paper. A quick example here before we move on. So what did we see in the previous ESRS, and how does that change now? So previously you had to document all possible IROs, even the immaterial ones, and now it's allowed to focus only on the clearly relevant IROs, which are embedded in the business model, and therefore also automatically material. So that doesn't mean that every IRO that you identify is clearly material and therefore automatically material, but it does mean that the simplification process has also kind of reached these aspects of the DMA. Before, you also had to subject every IRO to a thresholding analysis. So for impacts, you then look at potentially scale, scope, irremediability, and likelihood. And for risks and opportunities, you would look at magnitude and likelihood. And now for some IROs, if they are clearly material, no thresholding is required. And for impacts, that was also a process that was there before, but it has been simplified a bit. So what we're also seeing, one last point here, is that reporting efforts focus on the process documentation were required before, and now it's more of a reporting effort focused on clear outcomes and strategy links. So of course, that's a bit of a high-level bird's eye perspective on the whole simplification process, but that kind of is what EFRAG's mandate has been in the last months in order to simplify the DMA. So now let's focus on the technical updates and what we've seen coming out of EFRAG in terms of the specific details. So these slides are going to be a bit more dry, but I've tried to make them as interesting as possible. So what's changed in a fundamental sense is that we're moving from PATs to GDRs. So what does that mean? PATs stands for policies, actions, and targets. And we're now moving to GDRs, which stands for governance, strategy, impact, risk, opportunities, metrics, and targets. And essentially what we're seeing is that this shift brings quite a lot of changes to the reporting structure, and I'll explain why throughout these slides. So what we're seeing is that not most requirements of the text now sit in ESRS 2 and no longer the topical standards. Those of you that have worked with the previous ESRS will know that a lot of all the topical standards had requirements on policies, actions, and targets inside of the topical ESRS, and that's now all been moved to ESRS 2, so there's less overlap there. And we're seeing that in topical ESRS, there's only an addition of the topic, specific IROs plus metrics, no longer these full policies, actions, and targets lists. You must still state the absence of policies, actions, and targets if you do not have them. But it is quite a simple process to say we don't have them and we don't plan to have them, and that's not something that you will be penalized for under the new rules. Also, of course, what we're seeing speaks for itself, but we're seeing shorter standards, but a stronger emphasis on consistency across the reports. Here, a quick quote of ESRS 1 that I wanted to share that kind of brings together the main change here. And it starts with this small bracket that says new. And if you go into these amendments, for example, in the ESRS hub, you'll also see that they're either starting with new or amended, for example. And that basically refers to the changes. So it's quite practical to review. Anyways, it goes in its sustainability statement. The undertaking shall disclose information about the material impacts, risks, and opportunities organized under the topics to which they relate. This information shall cover the following reporting areas: A, governance; B, strategy, including financial effect; C, impact, risks, and opportunity management through policies and actions; and D, metrics and targets. That's essentially the core of the reporting process, but also kind of the core of this new GDR pillar that we're seeing. Moving on, so ESRS 1 is general requirements, and this is the only ESRS that you don't actually report on, but it's more of a guide on how to report. So this is basically where everything is explained. So if you have questions about the bigger picture of ESRS, refer to ESRS 1. So some key points here is that there is a now focus on materiality first. So you omit only what's truly non-material and you still justify it. But also good to note is that you can omit here it's quite a straightforward process. So you no longer need to provide a lot of documentation on why something is not material. You can provide that it's not material for your company. And under the ESRS guidance, something is material if it is important for the decision-making process of, for example, your shareholders or stakeholders in making decisions about your company. It is also clear about how to fill in the gaps. So you need to add entity-specific details where the ESRS doesn't capture it. That's even more relevant now as ESRS has been simplified, and they've also argued that, well, where we've made simplifications, We also give more flexibility in including entity-specific topics, so that if you as a company determine that, well, this is relevant for us after all, but it's been removed, we can still include it as an entity-specific topic. There's also the right level of detail now, which focuses on the aggregate or split data only when it changes the picture. So here we see that it's been simplified in the sense that you no longer have to automatically zoom into the smallest layer of your company, but you only do that when it's clearly relevant. And then there's the DMA flexibility. So the top-down approach is allowed, but not to avoid material issues. And then last but not least, so the reliefs are limited. So if it's about undue cost or effort, this is only allowed to be applied in limited cases. So as an argument, why not to report? But then again, the argument for not reporting based on materiality, for example, but also on the assessment of confidential information, that has been simplified. So as a company, if you say, well, this information cannot be shared publicly because it is confidential and it could, for example, be used by our competitors, then it's that process has been simplified to exclude information. For ESRS 2, this is kind of a topical or a cross-topic ESRS that everybody has to report on regardless of the outcome of the DMA. So this is the core backbone for governance, strategy, IROs, and metrics, and has become a bigger topic as now these policies, actions, and targets, for example, move towards ESRS 2. And it is, as I mentioned, applies to everyone. It sets the rules for how you explain impacts, risks, and opportunities, and it defines how you report methods, boundaries, estimates, and value chain data. So this is kind of where you start your reporting and you explain your value chain, you explain your company process, and you help the reader of your sustainability report understand the scope of your report before they actually go into the specific topics. Now let's get into the topics themselves. So what we're going to do in this section is we're going to focus in more detail on ESRS E1, S1, and G1, as under the previous ESRS, these were considered to be nearly always, almost always material for most companies. So more, the holy trinity of the ESRS. And then for the other ESRSs, we've given a bit more of a summarized overview just to be aware of time today, but also to focus on the most pressing ones. So for ESRS E1, the topic of climate change, we're seeing a couple of important changes here. So the transition plan has actually been upgraded. So you must now show 1.5 degree alignment with key levers and CapEx needs included where relevant. And that's interesting because for those that have followed the political process, one of the key points that often was discussed was this transition plan. And under CSDDD, which is the kind of the supply chain due diligence law, which will come in quite a few years later now, that's been removed. But under CSRD, it's still very much included. So you need to have a transition plan, but also the targets are clarified. So you need to benchmark against 1.5 degree pathways with clearer methods. This might ring a bell for those that are familiar with SBTI, the Science Based Targets Initiative, which essentially allows companies to report in line with the Paris Agreement. And if you do that, then this data point will also be a lot simpler for you to report on. Also, the scope 3 data points are clarified, so the boundaries, the methods, and the uncertainties must be explained, and that's also more in line with the greenhouse gas protocol. Also, we're seeing new additions. So, for example, the mandatory internal carbon pricing and the expanded financial effects. And this is interesting because it's quite strict data points, especially the mandatory internal carbon pricing. So here, companies must report on or set a internal carbon price for their company. In order to incentivize them to reduce their carbon intensive supply chains over the next few years as they set these internal carbon prices. Then here a bit of a brief overview, bird's eye overview of ESRS E2 to 5, so pollution, water, biodiversity, and circularity. So pollution E2, we're seeing a focus on the substances of concern, and microplastics is retained, but the granularity is recut, but still sector heavy. So here we're seeing, for example, that the substances of concern, which is SOCs, are still very important. And these are chemicals that pose environmental or human health risks and are regulated under EU law. So this is kind of a very clear scope. We're seeing the same for PRTR, which stands for Pollutant Release and Transfer Register. And this is an EU-wide inventory that tracks major pollutants released to air, water, and land. And then last but not least, they've also included the REACH list. So this is the registration, evaluation, authorization, and restriction of chemicals. And this is the EU's core chemical regulation. and basically gives you an idea that these are still very much around and also kind of across different regulations applicable. For water, we're seeing that there's a new water stress concept and stronger context on basin-based reporting. Freshwater wording has been removed in one metric, but in practice, firms report on the total freshwater, the totals plus the freshwater breakdown. And for biodiversity, we're seeing that they introduced a mandatory biodiversity transition plan, which is really interesting, but and also a buffer distance concept. So if your company is close to, for example, a water basin, then it must set a buffer distance in line with proper scientific evaluations. Also, targets and metrics are simplified, but still seen as burdensome and under-standardized by critics. What we're seeing here for circularity is that the scope is reshuffled. So, for example, biological materials is moved to G1, and some weight-based metrics are reintroduced, and a recycled materials data point is dropped. For weight-based metrics, that relies, for example, on the weights of recycled materials, but also the weights of waste that you're producing as a company. The focus here is remaining on circular inflows and outflows. Quick view on ESRS S1 on workforce, one of the other big topics that companies most often report on. So we're seeing that for adequate wages, you must check your pay levels against a living wage benchmark and show how you assessed gaps. So this hasn't changed. This is still something that we're seeing from the original edition, but there's updated thresholds. So more organizations must now report on turnover, training, and diversity metrics with fewer exemptions. And this is not a quantitative threshold, but it's more of a threshold on companies that can no longer say that they don't apply these metrics according to objective or subjective measures of exclusion. And then what we're also seeing, of course, and that's something that we're seeing across the whole ESRS, is that there's less granularity. So you need to report fewer breakdowns, but you must still split data where it changes the picture. So, for example, by location or contract type. And what we're seeing here is that this is now up to the companies themselves. So where before it was mandatory to report on location, this is now only relevant if it's material for the company to report on different locations. And what we're also seeing is that there's a clearer scope. So you include all the workers you direct and not just employees. And this is often what companies also already did before. But what we're seeing now is that with these new guidances, these questions that auditors used to have quite frequently, but also companies are reporting, are being addressed in a more practical manner. And that's, I think, really useful, just because a lot of us, and myself included, when we looked at the past ESRS, it was written in very complex terms. It was quite ambiguous at times, and it left these question marks that for reporting companies were hard to answer, but also for the auditors were hard to answer, which made the whole process in itself quite a bit more ambiguous. So I think one of the big benefits now of the new ESRS is that these questions have been answered proactively in these reporting standards. So for ESRS 2 to 4, which focuses on value chain workers, affected communities, and consumers and end users, what we're seeing is, for example, for value chain workers, is that there's a clearer scope and fewer mandatory splits, but also more flexibility using estimates for value chain data, which is in line with kind of the bigger picture of using proxy data. Then we're seeing for affected communities, there's a simplified impact list and a focus on material community risks, and no longer exhaustive checklists that cross kind of the whole topic. So also here within these topics, it makes it simpler to report. And then for consumers and end users, there's trim disclosures, which means that there's only emphasis on the core safety, quality, and marketing impacts only. And for G1 corruption, lobbying, and late payment transparency, we're seeing that there's a leaned out scope, so there's fewer mandatory data points, and a duplication with ESRS 2 is removed, as I mentioned in the beginning. So these policies, actions, and targets are no longer covered on, for example, G1 level, but on the ESRS 2 level. The anti-corruption definition is clarified, so there's clear expectations on policies, incidents, and actions, but once again, less clear or less granular breakdowns. The lobbying transparency is sharpened, which is interesting. So here we're seeing stronger disclosure on political engagement, positions, and memberships, which I think is a very welcome addition, especially now in the last couple of months that we've seen lobbying really take off in Brussels. And what we're also, the last point here is that the SME late payment metric has been dropped. So there's no more standardized metric, but the entity-specific disclosure is expected by material. So that kind of brings me back to the point I mentioned before, that while some of these metrics are being dropped, as a company, if it's relevant, you can still cover it as an entity-specific disclosure. And now another poll to see kind of the sentiment in the digital room here today. How prepared do you feel to work with the simplified ESRS in your 2026 reporting? A couple of answers here. There's also one answer for companies that are not reporting at all or not planning to report, but I'm very curious to see your updates. Let's see what we're getting. So 45% of you are saying that you're not reporting right now, which is fair. I think that's also because there's just a lot of uncertainty around the reporting process. I'm now seeing that this answer is being slightly overtaken by companies that are saying we're unsure and are still assessing what this update means for us. So that's an interesting development as well, and very much in line with what we're seeing here at CoolSet, with companies kind of waiting it out until the people in Brussels have made their final decisions before they then move on with the reporting process. Okay, interesting. Thank you. Brief overview of the further changes. So what we're seeing, and also as Freddie mentioned, there's more interoperability between ESRS, ISSB, and the Greenhouse Gas Protocol. So there's a closer alignment with the ISSB. So ESRS 1 strengthens fair presentation, plus the DMA to mirror IFRS S1 structure and principles. So here we're seeing that the ISSB and the ESRS are brought closer together. But we're also seeing that the Greenhouse Gas Protocol consistency is improved. So as I mentioned, the ESRS E1 clarifies the boundaries, Scope 3 methods, and 1.5 degree benchmarking. But it also updates rules for removals and credits to reduce divergence. So this is, I think, a welcome change for companies that want more coherence across the board and want less different scopes and exclusion metrics for what is included in Scope 3, for example. But what we're also seeing is that there's reduced duplication, as has been mentioned at this webinar a couple of times. So ESRS 2 centralizes governance, strategy, IROs, and methods, which also matches ISSB's architecture. And then one slide on the different waves. So as we know, Wave 1 reporters already are reporting on ESRS and have not been covered under the Stop the Clock directive. So these are going to continue reporting under the 2023 ESRS until the new ESRS are out, which means that they're approved by the Commission and have been published in the official journal. Then what we're seeing for Wave 2, which is these companies that are falling under the Stop the Clock, there's a 2-year delay. So your first report will be in financial year 2027 and published in 2028. And you can start preparing value chain and climate data early. What we're seeing with a lot of companies is that they're still continuing with this data and just reporting it elsewhere for the time being. So whether that is GRI, ISSB, EcoVadis, SBTI, there's a lot of kind of use cases for continuing your reporting process outside of just CSRD or ESRS. But what we're also seeing is that the disclosure load is changing. So both will eventually have to use the simplified amended ESRS once adopted, which does mean that for now, Wave 1 transitions earlier and faces more scrutiny as well. And of course, the materiality expectations are also key here. So we're seeing the same rules for both, but the Wave 1 is expected to show mature DMA sooner, while the Wave 2 builds capabilities during the delay. And then one last poll, just to kind of capture the sentiment across everyone attending today. What will be your top sustainability reporting priority in 2026? Is it preparing for CSRD under the new timeline? Is it streamlining the data process and governance? Is it minimizing compliance costs while staying credible? Are you not sure yet, or are you not reporting? Let's see what the outcome is here. So 41% of you, it's now fallen to 36%, are streamlining data process and governance. 25% are not reporting. 20% are preparing for the CSRD under the new reporting timeline, which is interesting. And then 9% of you are not sure yet, and 7% are minimizing compliance costs while staying credible. So interesting development, but also good to see that most of you ultimately are continuing with reporting in one way or another, even if it just means that you're keeping your data process in place. Okay, moving on. So we have some final slides on getting ready. So preparing for the new ESRS data requirements. So you need to map your organizational footprint. Do the CSRD requirements apply to you? And if they don't, will you report voluntarily, which of course is also an option. You need to retain your data pipelines already built for 2024, 2025. So don't shut off your momentum now. That's often the advice that I give. and engage your internal stakeholders, including the risk, finance, audit, and sustainability teams, and align on that very clearly, as often this is a very important process and can better be done sooner rather than later. Also, because once you start reporting, you'll notice that there's a lot of overlap in the data your teams need, and there's ways to streamline this process. Also, let this relief moment be a tactical pause and not a signal to stop, as you will start reporting again. Practical steps, so how to align early. So first of all, you need to focus on governance, strategy, and risk links, which of course are linked to the DMA. And this is still central under simplification. Second, which is important to consider, is that you need to build sustainability data architecture that handles both quantitative and data points and narrative context. So what we're seeing with companies that have already been reporting is that one of the bigger processes, especially in regards to kind of streamlining the whole process, is that you need to figure out where the data comes from and how to report on it clearly. Third point is that you need to clarify your data quality controls now, because drift risk increases when fewer data points are there, but also with broader exposure. You also need to document your materiality process rigorously, because the simplification may invite scrutiny rather than relieve it. And last but not least, use the simplification window to differentiate your company on transparency and integrity, not to dilute it. Very quick one slide on Coolset. So what we offer here is our ESRS module, which allows you to fast-track CSRD compliance and pass audits with confidence. So we have a pre-built workflow for double materiality and ESRS disclosures. We collect supporting evidence and maintain a complete audit trail, and we generate audit-ready reports. So if that's something that you want to evaluate together, let us know, and we'll happily show you the platform itself. But for now, we have quite a lot of questions I saw, so I'm happy to see all of those coming in, and to answer as many as we can today. Nice. I see one question with 13 upvotes. So let's see if we can provide a reasonable answer there. Question from Demetrius. Will there be an updated Excel file with the latest data points similar to the version released a few years ago, as it is difficult to create a checklist-style Excel file for the ESRS data points that remain mandatory? Very good question, something that I've also been keeping an eye out. So for now, these have not been released yet, but it is something that I expect EFRAG will release, as they've also done with their previous ESRS, and of course has been a great help to people reporting on ESRS. I think they will disclose it sooner rather than later, perhaps already in line with the updated documentation that they'll share end of this year. But I think it's more realistic that they'll only share this once it is final, which will be done after the commission approves. Another question here from Demetrius, which also has 5 upvotes. So thanks, Demetrius, for asking the right questions. Are the CSRD and the CS-DDD thresholds now final? So 450 million in annual revenue or over 1,750 employees, or are they still provisional? So here it's actually interesting, because the 450 million euros in annual revenue has been locked in. But now the the council and the parliament, they've agreed on a revised text, which says that the new threshold, or the final threshold, will be 1,000 employees, so not 1,750. And I think this is now the final number, but it will still have to be agreed upon in, I believe, the jury committee in the European Parliament, and then ultimately on the December 16th, so next week, Tuesday, they will vote on it in the European Parliament in Strasbourg, which will then make it final. And I know we've heard this word final a lot, but I think then we'll really know for sure that this is what we're expecting. But to give you my answer in short, I'm expecting 450 million euros in turnover and 1,000 employees per company. Let's see what questions here we have. We have quite a lot of questions, which is nice. Question here from Robert. If granularity is simplified and the geo level is removed, can an international operating company report on a consolidated level without specific market country reporting? That's a good question. So what we're seeing in the regulation is that the companies can report on a consolidated level, but then still need to provide those breakdowns into the subsidiary levels. And especially if you are a company reporting in the EU, you still need to provide all the relevant context. And as I also mentioned before, you can omit kind of a geolocation specific level. You can omit that, but only if it's not material. So if you have different locations with a different context, then you still very much need to include the different realities on the ground and not report on a higher level there. Let me look at some more questions. I think we're going to answer 2 more. So let's see what we have here. Question here from Leah, 2 upvotes. You mentioned that topic standards do not require policies, actions, and targets, but each of the topical standards has disclosure requirements which include policies, actions, and targets. Could you please refer to it once again to clarify it? So what we're basically referring to here is that policies, actions, and targets are kind of a standardized process under the ESRS, and that these were previously covered under these very standardized questions that were the same for every topic, but then basically adapted to those specific topics. So what we're seeing here is that we're now focusing more on only the entity-specific level. So you can say, for example, on a company level, you're reporting on all of your policies, actions, and targets, regardless of the specific topics. And then, for example, when you report on specifically ESRS E1, there you can then specifically disclose, well, regarding our decarbonization strategy, we have a policy which we disclose specifically here. I hope that that answers your question. Then we have one more question. Let's see what we have here. So I'll take the question from Nina. So what about companies that have a financial year from July 1st to June 30th? Since when are they required to report financial year 2026, 2027, or 2027, 2028? Also a good question. So as far as I understand it, you report earliest over 2027, and you are allowed to choose a financial year instead of a calendar year as your reporting year. But that means that you will then probably start reporting over the first half of 2027 and report over the first half of 2028 if you have a financial year that starts in July. I hope that helps answer it. If you have more questions about it, feel free to send an email, and we can also have a look and do a bit of a deep dive into the regulation to find any specific context if it is already there. Also good to note here is that not everything is final yet. So as Freddie also mentioned, there's still more documentation coming out that will hopefully provide more context on some of these questions. For now, I think, yeah, that's all. We also have our webinar next week with Andreas Rasche. Some of you may know him as the ESG Pope on LinkedIn. Yeah, he has a lot of interesting things to say, and we're very happy to do this webinar with him on the outcome of the omnibus vote and the UDR vote. So yeah, if you have any more questions on kind of the political process and the final outcome, for example, on the scope of CSRD, feel free to join us in that session, and we'll provide more context. You can sign up via coolcell.com/webinars. For now, yeah, thanks everyone for attending. We hope you found today's session useful, and looking forward to see you again quite soon. Thanks everyone.